Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. This week, I'm thrilled to be joined by Strategas President Nicholas Bohnsack to talk through some of the volatility this week. Nicholas, how you doing?
Always well, friend. How are you?
Doing very well. Thanks for asking. So, it's been a bit of a hectic last 5 or 6 trading days, starting with Black Friday. It's the Omicron variant. It's the Fed pivot to tightening. Just high level, how are you all thinking about this volatility as it stands today?
Yeah, I think it's important anytime there's a market event or the market is reacting to events is not to lose our head. It's really important when we see these little episodes of volatility to sort of just sit back. Remember we've got a plan and see if that plan needs adjustment, but not to overreact. And I think from our vantage point, the market had sort of settled in, and investors generally had sort of settled into a little bit of a mode where they had sort of reconciled that growth was improving, maybe wasn't as terrific as they thought it was at the beginning of the year, but improving all the same. It was. COVID seemed generally under control. We sort of understood what the Delta variant was. We were probably starting to acclimate ourselves to this notion that we were going to have slightly higher inflation than policymakers had, originally laid out. And then I think this Omicron variant sort of came in and sort of disrupted all of that thinking. And I guess by our lights, and I'll just make this point sort of quickly, is that and I don't want to be flippant or cavalier about the virus. I think from an investor's perspective, the concern is less about the new variant and more about the potential for a policy error in addressing it. Right. And it would seem to me on both sides of the political aisle, commercially as well, there's just a real fatigue about lockdown. And so when you start to see travel restrictions and mask mandates sort of creep back into the frame, I think that gets people sort of back on their heels a bit.
Yeah, I agree. And, you can kind of see it rippling throughout the headlines and the volatility in the market. I'm struck by the idea of a policy error. I struggle with whether, a new variant would be deflationary or would be inflationary if it were to, really inhibit some of the supply chain things that we've already seen be troublesome. So how are you all thinking about inflation with this new variant? And what do you think a policy mistake looks like on the monetary policy side at this point?
Yeah, well, I think if we look back to the original or the initial onset, I should say, of COVID, there's no question that there were some disinflation and deflationary overtones to that episode, really in the second quarter of 2020. And now, 18, 20 months along, it's very clear to us, and I think to the market as well, that we're sort of suffering through more of an inflationary circumstance. When you think about the monetary policy side of it, and one of the reasons that we think the Fed's intention, even as they sort of jockeyed with a little bit of the personnel issues here related to the chairmanship over the last month, is they want to accelerate the taper. And I think they want to accelerate the taper for two reasons. The first of which is that if you're tapering, you're still buying bonds and providing easier monetary policy. So, it's pretty clear that the policy prescription that we've got today is not the one that we need. And so they want to accelerate that taper because they probably recognize that they're already behind the curve as it relates to inflation and raising interest rates. So they want to sort of pull forward that optionality. The second is because the economy has generally done pretty well over the last year, and because we are also after October 1st, moving into a new fiscal year where there's actually fiscal drag, i.e. the government, believe it or not, is spending less money than it did in this fiscal year than it did in the last fiscal year. Treasury issuance is down. And so if the Fed doesn't accelerate their taper, they actually start to become the entire Treasury market. And so they don't want that either. And so I think that the chairman, with his renomination secure, is trying to advance that conversation. And that's a decidedly different change in tone, or that is a change in tone from where they have been for the majority of the year. And so again, more than Omicron, I think the market is adjusting to what does a hawkish Fed look like, particularly if inflation is sort of cresting, not just domestically, but abroad at levels that we haven't seen in several decades in many cases.
Yeah, Fed Chair Powell got renominated and then got rid of that transitory language pretty quickly there.
Yeah, like about a week. It took him about a
Yeah,
week.
it didn't.
Um, yeah, it didn't take long. So then, if inflation is likely to be with us next year, variants and the pandemic and potentially endemic in some form will still be with us next year. What is your broad outlook? Sectors, asset class positioning. I know you're remaining pretty pro-cyclical. What are you looking for on that front as we head into a new year? And are you sticking with that trade at this point?
We are. I think we remain fairly convinced that the economy is, albeit in more of a jagged fashion than perhaps desired, is making the transition from a recovery to a self-sustaining expansion. And what's interesting is that the adoption of new operating practices by corporations may in fact be the organic driver of growth that we've been searching for this whole time. And so we remain fairly bullish on sort of the cyclical idea. A report we put out earlier this week, we said, cyclical trade shaken, cyclical recovery intact. And so we've got a period of observation here the next couple of weeks where we're going to be looking at 6 or 7 data points to give us a good read as to whether we're wrong, and perhaps energy and financials and some of these other areas suffer more permanently. So, we think about things like credit spreads getting back up above their September 20 highs, so a little bit more than a year ago, 15 months ago. They're well below them at this point, so we haven't seen a lot of strain in the credit markets. Second to that, we would look at the yield curve flattening. And I'd say that's the one that's probably sort of the most in our face, because the curve is pretty flat at about 83 basis points. I think we can look at data from the TSA, the travel throughput data. We can look at open table data in terms of people making restaurant reservations, mobility data, that'll be important. Margin deterioration from the S&P 500, that'll be more of a quarterly concept. But if we start to see some fatigue in the profitability of sort of the big indexes, that'll be something we want to pay attention to. And so we remain cyclical. We want to watch the performance of the defensive stocks. We want to watch how the schools respond, if it's more than just mask mandates, but maybe closures and distance learning. And then ultimately, we want to check out employment claims. I think and I'll leave this with you here, I think one of the unknown facts about the fourth quarter, for as much as we've been dealing with in terms of the headlines, is that the Atlanta Federal Reserve, their tracking metric for U.S. real GDP sits above 10% quarter on quarter at an annual rate. So, the economy came into the fourth quarter with a lot of momentum. We still think it has a fair amount of momentum. We'll certainly have to digest some of these elements that contributed to volatility, but I think it's, again, important to sort of keep our heads, stick with the plan. And for the time being, we're sticking with ours, which is to sort of continue to look optimistically on the cyclical trade and the cyclical recovery.
Some really good advice to close with, and some things to keep an eye on for our clients and investors out there. So really valuable. We really appreciate the time, and have a great rest of your year.
You will. I'll talk to you soon.